Good day, all. Ira Epstein of Linn & Associates with your metals market update, and this is for Thursday. We're right now at the 14th of November, 2019, just after 3:40 p.m. Central Daylight Time. So these aren't yet the settlements. I've already looked to see where they're at. They're around the 1473 area in the gold market. I think there were 1702.5 in the silver, 262.15 in the copper, and about there in the platinum market. We're getting a bounce in the metals, but I don't think you can really call it much more than that. And things are very quiet from the stock market on. And let me explain why. We have another set of hearings tomorrow at the House of Representatives, and we're going to find out another level of what people think. Yesterday's hearings, I think we were all glued to the TV, and I want to call it the hearsay hearings. And that's not positive or negative. I'm not saying the House is doing anything wrong. Let's start there. But I was looking for somebody to say, I heard the president do this. So far, everybody has heard somebody else that told them that they heard something. Is it enough to impeach? That's the point. Well, I don't think it will pass muster in the Senate, but we're nowhere near through with these hearings. There could be a bomb out there. We don't know. And that affects the markets. So as you get into these hearings, I think you're getting short covering because people get nervous. The other thing certainly has been a certain move to some safe havens in the bonds and the notes, the metals as well to a degree, because the U.S.-Chinese trade deal keeps stalling out. Every time we think we're going to do something, and it's been this way since May, when we thought we had a deal wrapped up on something. We find that we have nothing wrapped up. We're back to square one, like it or not. The Chinese want to buy what they were buying before this whole thing began in 2018. I don't know how to say it any different. That's what they want. They don't want to be told they can't make subsidies to companies that they think are important for their well-being. How are you going to stop that? And of course, the forced transfer, well, the world's against them on stealing technology. But how do you get to the first phase of a deal? In the gold, you broke the back of the market when you put it underneath the 18-week average of closes. So I have every reason to suspect that if you rallied from here, resistance would show up at that number. And I say that because we hadn't done anything. We went sliding through it like it didn't exist here. My experience has taught me that doesn't mean that you'll stop on the way up there, but more times than not, yeah, you struggle at that number. So we'll see what happens. When I look at a daily bar chart, you know that you broke through all this area, sliced through that, and washed the market out to a degree. We have in place a pattern of lower highs and lower lows as the swing line portrays it. Now what the swing line looks for, and that's this number, there's a chart without it, with it. It looks at the previous day and decides, does it draw a line to the current day's high or low? I teach it in my charting course. People have asked me, in fact one of you just did on the YouTube, about moving averages. Well, I teach all that in the charting course. So if you want to know why I use the averages I do my best to explain it there. But is there any one right number? Let me give you a little history from me. I used to buy services years ago that would optimize what moving average for, let's assume, of closes works best in each commodity. And at the end of a couple of years of paying for that, I decided I was throwing more money out on that service than it was worth, because it came back to me saying, I think there's one number that does the job pretty well. I'm not looking to be exact. Let's understand that too. In other words, if a market gets to 1800 and that's a zone I want to come out and it hits 1799, are you waiting for the 1800? If you do, a little bit foolish. I used to learn from what I thought was one of the greatest point and figure traders I ever met, and this had to be 40 years ago. And I saw the flaw in the man. If it didn't get to his number, it's going to go back there. Yeah, you're broke in the process. So as I look at this market now, I'm seeing convergence of resistance. Remember we were just talking that 1487 level on the chart? Well, look at this. You're right back here. 1485.50, 1487. So in looking at this market, I think the bears are looking at that number, and people that may be caught long, that could be a number that they're going to use as a resistance point. If you were to take out 1495.90, this wave to the downside would be fully negated. In other words, it would have run its course, gotten under the Bollinger Band for a short period, and all of a sudden gone with a lower low, higher high. It can certainly happen. I don't know the events of tomorrow, but as a chartist, I'm looking at that right now as the resistance, and I would think that the bears want to defend the market to not get over that number. Where's my momentum? It's turned up. So I have a momentum that's turned up, but is still in oversold territory. That's a problem for bears. Bears typically don't like selling oversold territory. Whether they're using an MACD, a relative strength, a Chalkin indicator, I can go on and on with all the indicators because I've used them all, or at least most of them. The concept is you like to get away from the oversold. To get away from that, these numbers have to get over 30. So as bearish as I am at that number, I'm fearful. I don't like going into markets. I don't like buying an overbought market and selling an oversold market. As we get over to GLD, it too, coming away from the lower band, first resistance, 100-day average, second, the 18, so this zone is it. What they don't want to see taken out if you're in the bear camp here is 140.79, but it's the same problem. You're oversold, or you're going to get the pros to really support that at this point, in other words, selling. When we come to the GDX, let's first start with the big one. Where are you back to? Right back to that line in the sand. So you have a market that culminated its drop right through here, got right by the Bollinger Bands, had a reversal day up. The logical target, if the market turns up, is the 18-day average of closes. It went there, and now it's just sitting. Are we trending? Absolutely not. But it is a market that has worked its way. It's no longer oversold. There's the difference on one part of it. When we go to the juniors of the miners, and that's what these are, the first resistance, we can come, I wish I could make these move. I can't the way it is. But lower highs, lower lows, the market got itself oversold, didn't quite get to that Bollinger Band. And again, it's a zone. Don't have to hit it. But here's your resistance. The 18-day average, I'll stick with that, and the 100. This is not the 100. That's the 45. That's the 100. So I've got those two on there. I could take off the 45 so they both would have that and you'd be clearer with it. But I do use the 45 because sometimes the 100's further away. It's a nice zone, but I know I've got one right there. Some traders use the 50-day. I don't know what's right and wrong. I know what I'm comfortable with after the years. In the gold-silver ratio, this still favors the gold. So silver is the laggard here. Anytime you're over this number, that 18-day average, that's my theory on it. And that's not a good sign for the bull market and metals to come together. I often want to see those base metals participating, and they're not. When you come to the silver, lower highs, lower lows, this is a clearer chart, more under the Bollinger Band, popped. First resistance, 100-day average, then the 18, and I see the traders in this market being bearish. Now, something else. Both numbers under 20 today. Both numbers under 20 yesterday, not the day before. Tomorrow is a very important day. And the reason is it takes 3 days to develop an embedded reading. So you typically don't embed. So I wouldn't be surprised if the market tries to rally a bit. And that all fits in. We're going to be watching those house inquiries again, if you will. In copper, all you had to hear is that the U.S. and China aren't doing well. If you knew nothing else and you're already down into, and this is where you were yesterday, if you're down into the 100-day average and you haven't hit the Bollinger Band and you're oversold, you know what I'm going to say. I'm looking for support if the market continues down right against that number, and that's exactly what it did. It went down there. Now, I think pros took money off the table. I know that it looks the most bearish here, but that's what I think. And I think that today's high is going to be an important number as it's an outside day down into new lows for this move. In the platinum, you're getting a breakaway back over the Bollinger Band. Okay, but I see resistance at the 100-day and then up at the 18. Oversold, not embedding. In the palladium market, again, you hit this Bollinger Band and you're getting a bounce. There's no trend change here. You still have lower highs, lower lows. So the metals as a whole, none of them are in the bull camp in any manner. And in the dollar index, you pulled down today, and instead of breaking through the swing line low, you held it. Now, what about the embedded reading that's developed here, or developing? Both numbers are over 80 today, both over 80 the day before and the day before. So if you lose the embedded reading, in other words, the red line gets under 80, I'll go on record saying that I would expect that price and the 18-day average make a run at each other. But until that occurs, I expect the bulls are in control and they'll fight to keep control of the market. That's where I'm at on it. You know, I talk all these indicators, but possibly you want to learn about them. And with that, we put together volumes 1 and 2 of our Guide to Technical Indicators. And it covers what you see me talking here and a lot more. It's going to deal with price-time relationships, the different types of charts. You can have bar charts, line charts. You're seeing some of them right here. I used to teach point and figure charting years ago. So I've done all that type of stuff, and that's why I think I can talk to you. Got the experience, have done it. These new algo kids, they're beyond something I do. I understand the theories in concept. I don't know how to do what they're doing. That's very different. But again, they're looking at it from a math way. Here's the probability of X and X happening in a very, very, very microsecond short period of time when they're going in and out of these markets. That doesn't mean they can't catch trends, but at some point along the line, built into their algos is something that follows and predicts for them trend. And the game doesn't change. The time horizons can change. What else happens in an algo? The idea there is that you're not thinking, the algo's doing the thinking for you. If all the algorithms won, you do realize there'd be no markets. Because if the market's going up, they'd all be long. People ask me this all the time, and I go, it's not how it is. You can make money on spreads. You can do things like Citadel does and the brilliance there. There's many things. But to learn the technical, why not take a look? And all you need to do is go to our website, sign up for the PDFs you'd like to get. We'll get them right out to you. You can click here and that's it. And at least you'll have a working definition of what this is all about. If you take my charting course, you'll learn my terminology, my way of doing the charting, and the disciplines that I try to keep in place. I'm Ira. You have a good day, and I'll see you tomorrow.